Okay, welcome everyone to this session, Financing the Green Energy Transition and Low Carbon Infrastructure, sponsored by Camco Clean Energy. I'd now like to welcome up our moderator, Kalsey Belle, to take the stage, introduce herself. All the best for the panel, and thank you, everyone.
Good morning. Thanks, James. Good morning, good afternoon, and good evening to everyone. Welcome to the Island Finance Forum and this particular panel. First of all, I'd like to thank Island Innovation for organizing such a forum at such a timely point, and also to our panel sponsor, Camco. I would also like to thank our excellent panelists for joining us, and to all of you from across the globe for joining us today. I'm Kalsey Belle, an islander from the Seychelles, and I will be your moderator for today. I'm currently based in the neighboring country, another SID, of Mauritius, where I work as a coverage officer for the Eastern and Southern African Trade and Development Bank, TDB. TDB is a multilateral development financial institution. We serve 22 economies in our region, financing and fostering trade, regional economic integration, and sustainable development via trade finance, project and infrastructure finance, asset management, and business advisory services. The impacts of climate change continue to be felt across the globe. The rise in global average temperatures from the buildup of greenhouse gas pollution is triggering more severe and frequent extreme weather events. Climate change has no borders. Its impact has no limits. It is potentially the biggest challenge we're facing this century. Realizing this, nearly every government has adopted the Paris Agreement. The goal, to reduce greenhouse gas emissions and limit global warming to 1.5 degrees Celsius. To achieve this, countries have submitted nationally determined contributions, NDCs, where they communicate the actions they will take to reduce greenhouse gas emissions and build resilience to adapt to the impacts of rising temperatures. The NDCs have targets to increase investment in renewable energy, energy efficiency, and low carbon infrastructure, amongst a list of others. The targets are a concrete signal to all of us, private sector, NGOs, governments, financing institutions, that we must all commit to working together towards a green energy transition and low carbon future. The next step is financing the green energy transition and low carbon infrastructure, the subject of today's panel. As small island developing states, we are at the forefront of the battle against climate change. Our distinctive characteristics present unique challenges in financing our green transition. On today's panel, our esteemed speakers will share their experience on the role of finance as an enabler and ways in which we can unlock financing and overcome challenges so that we can pursue and realize our green growth ambitions. With me on the panel today is Exsley Taloiburi from the Pacific Island Forum Secretariat, Geoff Sinclair from Camco, Thomas Jacobs from the IFC, and Ahmed Badr from the International Renewable Energy Agency, IRENA. On today's agenda, each of our panelists will address us before we enter into a question and answer session. So I'd like to invite all of you in the audience to send any questions you have through our Q&A function for us to address during the question and answer slot. And don't forget to state your name, your organization, and where you're from, because I think it'd be really interesting to see where everybody is joining us from. So without further ado, let's get started with our first speaker, Mr. Exsley Taloiburi from the Pacific Island Forum Secretariat, who has over 15 years of experience in climate finance analysis, disaster risk finance, and governance. Over to you, Exsley.
Thank you very much, Kalsey. And I'd like to also recognize the distinguished colleague panelists and also the participants that are joining us from across the world, either on the Zoom platform or also live on stream using the Facebook channel. A very good evening from Suva here in Fiji. I'd like to start off by taking this opportunity to thank the organizer, Island as the sponsor for this session, for inviting me to be part of this event on behalf of the Pacific Islands Forum Secretariat. Today, my contribution will focus on a Pacific regional perspective on this topic, financing the green energy transition and low carbon development. I'd like to start by providing the context of the situation in the Pacific As most of you would be aware about the situation that we States, our collective emissions is a mere 0.03% of the global emissions. One might say structure, it may not make much difference to the global emissions trend. From an economic perspective, in the short to medium term, the transitional costs will be very costly to the national economy as it requires changing the relevant laws, systems, and also infrastructure, which is a difficult decision for Pacific governments at this time, noting the economic impacts of the pandemic. In saying that, the motivation for Pacific Island countries is attributed to the following. The first is the long-term economic benefits that will be accrued due to savings from phasing out fossil fuel, and also the subsequent reduction in the cost of electricity power, which in our context is a big contributor to development and also improved services in our Pacific small island developing states. Opportunity for Pacific SIDS to demonstrate our moral authority and leadership on climate change, that despite our capacity constraints, we are still doing our best to address the global climate change crisis that is facing the global community. Allow me now to share some specific examples of actions that Pacific SIDS are driving. Well before the concept of the INDCs came about, Pacific Island Forum leaders have already been taking the lead in terms of issuing the Majuro Climate Leadership in 2030, contain a commitment to achieving 100% renewable energy 30, also commitment to phase out the importation of fossil fuels. Was further elevated now into the NDC commitments from the Pacific SIDS, where a significant portion of their targets are focused on the energy and transportation sector. In Palau, for example, the government has been working closely with the National Development Bank and partners to finance an energy efficiency subsidy program, which allows people of Palau to own new energy efficient homes. In Vanuatu, the government has recently set up a national green energy fund to finance renewable energy and energy efficiency projects, as well as promoting private sector investment. In Fiji, where fossil fuel imports account for 25 to 30% of all imports, the government has developed a green growth framework aimed at greening Fiji's economic base and transitioning the land transport sector here in Fiji. At the regional level, regional organizations under the leadership of the Pacific Community, we have recently developed a regional energy framework, 2021 to 2030, which is also underpinned by this issue in terms of addressing the regional Pacific SIDS have tapped into financing support from the GCF and ADB to implement the Pacific Islands Renewable Energy Investment Program. Drawing on these specific examples, I would end and sum up my intervention by highlighting three key lessons. The first is that the project modality by development partners could be a source of joy or despair for Pacific Island communities. Partners will need and capacity building for new technologies in their interventions. In Tuvalu, for example, there was a solar electrification rollout to outer islands recently that were using diesel generators for power generation. Now, at least 3 of those interventions have died out and the people are now without electricity. The second lesson learned is that most of the power supply in the Pacific are centralized and supported by government. There is a need to update relevant legislations to open up for private investors. Also, there is uncertainty on who is going to pay and guarantee takeoff. Despite our national economy is not big enough to attract private sector investment, there is opportunity for regional or multi-country programs. This is something that we have really interested investors, including Camco. Lastly, there is also the lack of a central information bank of data where investors would be able to assess the risks and opportunities they need in order to invest in this green energy development in the region. With that, I think there's an opportunity to enter into genuine partnerships with our partners that are working in the Pacific to be able to address some of these issues and the gaps that we have in the region, and also to be able to achieve the intended transitioning to green energy and low carbon
Can you all hear me? I think it's frozen on my end. I'm not sure if everyone can hear me, but thank you, Exley, for the intervention. Yeah, James, can everyone hear me?
Yes, we can hear you, Kalsey. Go ahead.
Thank you. Yeah, Exley, thank you so much for this intervention. And yeah, as you rightly said, a lot of SIDS are not, we're not at fault for the climate change per se. We haven't speeded it up as much, but we are suffering the consequences. And it was very, I loved all the proactiveness that the Pacific Islands have shown, and from the key lessons learned, I hope our fellow panelists will be able to provide a bit of some solutions that we could go towards to address those key lessons learned. So let me keep the ball rolling and move on to our next panelist, Mr. Geoff Sinclair, who's the Managing Director of Camco and has over 25 years experience in clean energy and climate finance. Over to you, Geoff. Welcome.
Thanks, Kalsey, and hi everyone. Thank you for attending the session, and I hope it's a useful one for all of you. By way of background, I'm from Camco. Camco is a climate and impact fund manager leading the clean energy transition in emerging markets. We've been operating in this market for over 30 years, have supported over 200 projects with $15 billion. We're a GCF accredited entity, and we currently have operations in Europe, Africa, and the Caribbean. I'm just enjoying working from home here, so excuse me a moment. At the moment, our main areas of activity include REP, okay, thank you very much, a $200 million fund focused on small and distributed renewables, Spark, a financing platform for developers of commercial and industrial renewables and energy efficiency, and the Credit Risk Abatement Facility, or CRAF, a credit guarantee facility being developed by the CARICOM Development Fund for small and medium-sized enterprises to do renewables and energy efficiency in the CARICOM region. I think I just make a few points to kick off, and then I think it'd be always more satisfying to engage in a conversation. One point is that certainly by my observation, the potential for low carbon infrastructure in islands is significant. And so from a financier's point of view, there's an opportunity there. And the reason we see that opportunity is that most islands are heavily reliant on imported fossil fuels, and they cost a lot of money, and they cause a lot of logistical problems and exchange problems. And so moving to low carbon infrastructure is actually just commercial common sense, rather than necessarily being some sort of barrier. Despite that opportunity, there's still a huge gap to bridge for islands, both in taking advantage of that opportunity, but also to implement their Paris Agreement NDCs. Again, if I talk about CARICOM, 92% of all energy generated uses fossil fuels, despite the ambitious decarbonisation targets in those countries' NDCs. The policy and regulatory environment tends to lag, and there is a significant financing gap. From the point of view of that investment or financing, the funding landscape tends to be dominated by support for utility scale installations. And I'm sure we'll hear a bit more about that on the panel. there are significant funding and balance sheet constraints at the project development stage, at that risky end of things. There tends to be an absence of the sort of the ecosystem that you need to do multiple smaller energy efficiency and renewables projects, so energy service companies and developers and the like. There's a lack of local bank financing for renewables and energy efficiency without quite significant collateral requirements. And government balance sheet constraints generally require, or there are significant government balance sheet constraints, and so they require mobilization of private capital to meet the NDC targets. So for example, in March this year, Antigua and Barbuda indicated publicly that high public debt levels were a hindrance to financing renewables. Some examples of areas that could do with more activity: upgrading generation equipment, meeting increased demand from commercial and industrial sectors, transitioning to lower carbon sources of energy, better utilizing and building local capacity and local talent. And overall, I think there needs to be more of a sort of an industry ecosystem approach to building out the sector across all of the islands. Some of the new developments that I'm aware of seeking to address this from a financing point of view include risk guarantees. So for example, in the Caribbean, we've been working with the CARICOM Development Fund and a number of other organizations to develop a default guarantee for banks interested in green financing. That's CRAF. A second model is a sort of an integrated utility service model and ESCO financing. So for example, GIZ, the Caribbean Development Bank, and CARICOM Secretariat undertaking a CARICOM IUS model development for implementation in Barbados, Guyana, and Belize. And of course, Spark, which I mentioned earlier, that we're doing for financing commercial and industrial applications. I might stop there, but I'm really looking forward to a great discussion. Thanks.
Great, thank you, Geoff. That was, you've brushed on a common theme here where we need more mobilization of private sector funding, which is perfect lead on to our next panelist, who is Mr. Thomas Jacobs, who is the the IFC country manager for Australia, New Zealand, Papua New Guinea, and the Pacific Islands. Just before Tom takes the floor, I'll just give a brief overview of the International Finance Corporation, IFC, which is part of the World Bank Group and focuses exclusively on private sector development. It advances economic development and improving the lives of people by encouraging the growth of the private sector. IFC helps countries develop their private sector by investing in companies, mobilizing capital in the international financial markets, and providing advisory services to business and governments. With that, Tom has joined IFC since 2003, and now he will share his experience in the Pacific with us. Thank you, Tom.
Many thanks, Kalsey, and good evening and good morning, good afternoon to all the audience. It's a pleasure to be here. A lot of the points I think that are really germane to the Pacific have been made by my panelists, Exsley and Geoff. But I may take a bit of a contrarian view on one aspect, and I guess I would venture to say from our experience that finance may not be the major constraint to the energy challenge in island states. I think it's the availability of bankable projects, which I think indirectly my co-panelists touched upon. There actually is quite a lot of money looking for deals in the Pacific, for example. If you look at the pension funds in the Pacific, they represent about $8 billion US that could be invested in infrastructure and greening the infrastructure across the Pacific. And the banking sector is very liquid. There are lots of private investors looking for deals, but the challenge is trying to find projects that are commercially viable. And I think Exsley touched upon some of those issues in terms of off-taker risk, but there's a whole host of issues that need to be dealt with to finance a sort of a scalable project, and particularly in small island states where capacity is weak. You've got legal and regulatory risks you have to deal with. You got the regular commercial risks, your environment and social, your construction risk, all the political risks, exchange rate, natural disasters, political tensions, and so forth. And I think that's one of the reasons why it takes very, very difficult to build bankable projects. And I think that goes to the point where I think Geoff made earlier about needing various players who can play different roles. And governments in the Pacific and across the world really right now are all constrained fiscally. So trying to find ways to crowd in the private sector is even more important than it ever was. And that's obviously the main thing that ISE tries to do. But sometimes you'll have some public finance, you'll have some financing from the likes of the World Bank. On the other hand, you've got private investors and financial investors and funds, but then there's sort of viability gap in the middle that someone needs to step in. And I think that sometimes will place groups like Australian government in the Pacific or New Zealand or other bilaterals can come in and play a really essential role in what we call at IFC the cascade, is like starting at the top with, can the private sector do the project on its own? If so, let them, and if not, minimize the concessionality and take the pressure off the public finance as much as you can. And there's a host of different financial instruments out there, and I think Geoff touched upon them. We can go on them a bit later, but I thought it might be useful if I can touch upon one sort of test case study. And I'd be a bit careful because this is around the Solomon Islands, and I learned this evening that Exsley is actually from the Solomon Islands, and he can make sure I'm speaking the truth about the Solomons. But we've spent a long time there trying to do quite a large project, and I'm going to try to share my screen. And it's not a PowerPoint per se, but it's one slide I thought might be useful just to demonstrate the complexity of what we're trying to deal with. So if you look at the situation of Solomon Islands, a country of about 670,000 people spread out over 1,000 islands, it has some of the world's highest electricity costs at about 82 cents per kilowatt hour. Only about 15-16% of Solomon Islanders actually have access to the grid. And it's a very challenging place to do large scale projects. So if you look at this, project we did in over the last 10 years, it started with the World Bank, in fact, doing a feasibility study that led to ultimately IFC taking on the role of transaction advisor to try to pull together a project that we could then take to market. In the end, we were successful in getting a Korean investor to come along with an engineering company from Korea as well. And then we had to wrap a lot of concessional funding around it to make it happen. And part of the challenge was when we started the project 10 years ago, oil prices were much higher than they were today. So as that tariff has fallen, finding the right level of concessionality to make the project bankable has been a challenge. But you can see where all of the different steps that it takes to do a large scale project of this sort. And this is about a 250-270 million US project.
Sorry to jump in. We can't see the slide that you may be sharing. It hasn't appeared on our end. Sorry to
Oh, okay. No, thank you. Can you see it now?
Yeah. Yes, now we can. Thank you.
Okay, my apologies. So, I mean, as you can see here, all the steps it takes to actually get a project of this complexity completed over a 10-year period, and particularly in some of these small island states in the Pacific, landowner issues are a major challenge. And I think in this project, we were able to develop the very first sort of landmark type of agreement where the project company actually pays over time a series of emoluments to landowners. So they get compensation throughout the life of the cycle and beyond. But it's everything from, someone like IFC coming in can put the financing package together. Then you've got a host of various financial parties that have to put the money up, and partly it's the private, partly with sovereign wealth funds, World Bank, Asian Development Bank, the Australian government, Green Climate Fund, and then even you bring in MIGA, the Multilateral Insurance Guarantee Agency, to cover some of the political risks that K-Water and its partner were facing. So again, this just shows the complexity of trying to do these large-scale projects. On the other hand, if you stay the course, this will be a game changer for Solomon Islands. They will go from virtually no renewable energy to 70, 80% of renewable energy through this one project. And I think it's something that we're quite proud of. I've got another case study I may bring up a bit later about an alternative way to finance smaller scale projects, but maybe let me stop there and turn it back to Kalsey, and then I can come back with the other examples later if they're of interest. Thank you.
Okay, thank you, Tom. So another interesting theme was brought about now with regards to not just financing, private sector financing in constraint, but the bankability of projects, which transitions us perfectly well into our final panelist, which is Ahmed, who has more than 20 years experience leading and executing infrastructure and environmental projects across Africa, Asia, and Europe. His current role is as the acting director of the Project Facilitation and Support Department at the International Renewable Energy Agency, IRENA. Without further ado, I'd like to invite Ahmed to tell us more.
Thank you very much, Kalsey, for your introduction. Actually, I enjoyed the whole intervention by Exsley, by Tom, and by Geoff. Well, I first of all, I agree with all interventions. By definition, I started my career as a young professional World Bank, and then moved to several banks, lasting by EBRD in London. So the reason for in my intervention actually will start with the following fact that IRENA realized actually the importance to provide this intervention as a new division created within the agency in order to work along the key issue that specifically mentioned by Tom, but earlier by Geoff and Exsley, about the need for creating a very robust pipeline of projects that's really matching the interest of the development financial institution, and more important with the private sector investors, whether investors or developers. And here either at early stage or at late stage of intervention, because as we can see from the previous slide of Tom, let me capitalize into that, Tom, it took about 15 years for such large a project to come in. But if we in IRENA came with our calling bar and competitive advantage globally to arrange for this bankable project information document that basically developing all elements, not only about the securing the concessional financing, which basically the other second challenge that I will come to it in a second, but with all elements including risk analysis, mitigation, or what type of risks that would be mitigated, what kind of risk hedging, what type of risk conveying to other insurance agency. I think that is really the case. And this is the new divisions that I'm created. I am mandated to be created with upon the approval of the General Assembly, is to work on project facilitation and supporting projects. This is for sure hand in hand going with the development of the second phase of the IRENA EDFD facility, but this time the new facility will be working among several multilateral and bilateral and private sector banks to come up with this funding facility that basically will work on providing such kind of demonstrating pilot projects based on this project facilitation that the new division is creating. I would like also to talk before giving the floor back to you, Kalsey, about the very important aspect of that the second challenge, in addition to the absence of or the need or global need to work on building back better the global economy after the pandemic, of having very robust pipeline of bankable projects, is actually the availability of relevant concessional funding. Actually, the main problem here is not availability of grant aid. It's more important is a concessional funding that matches the bankability dimension of projects. And again, that example given by Tom is a good example for that, as well as the several examples mentioned by Geoff, because it's not only about normal debt to be structured in a structured finance way, but it's also sometimes it could be mezzanine financing, de-risking financing tools. Also, the third element is the presence of what I call it catalytic funding, like various loss facility that we are also creating and building now. But in the meantime, when we come to the question and answer, I have several examples of projects that we worked with some bilateral financing institution, and we reach out financial closure in a very agile time, in less than 3 months instead of 1 year or 15 months, like for example, the Spanish Development Agency, Covedis, and I will come to that during the the Q&A session or the subsequent questions. I will stop here, respecting the time span that have been given by Kalsey as a moderator, and over to you, Kalsey. Thank you.
Thank you very much, Ahmed. So we will go directly to the question and answer session. I'll just like to encourage all of you in the audience to please submit them in the Q&A function that we have. Right now we'll go directly to our first question, which would be addressed to Tom, I guess. What about a Pacific Green Investment Bank, which might invest in or fund many smaller projects across the Pacific Islands? So you achieve volume and diversity at a lower risk. Tom, I'll allow you to elaborate perhaps on this one.
Okay, I want to make sure I'm audible and visible to the extent need be. So how do you finance smaller projects across the Pacific Islands? Is the gist of the question? I can't hear you. You on mute?
Sorry, yes.
Okay.
Sorry, the question is a suggestion to have a Pacific Green Investment Bank.
I'm sorry?
A suggestion, the question is a suggestion of having a Pacific Green Investment Bank that can invest and fund many smaller projects across the island.
Fair enough. We've actually looked at considered looking at something like that here at the ISC, trying to find some way to professionalize and aggregate the identification of projects. But I think we still go back to this issue of pipeline of bankable projects. And I know one of the questions I saw came back, wanted a bit more on what that means. I mean, I guess you look at two sides of it. I mean, if you have large projects that are complicated, then you need a really sophisticated approach to identifying what are the risks, what are the objectives of the project, and then trying to find ways to bring quite a number of different parties together to address the different risks involved and to ensure at the end of the day that there's a commercial return out of it. So in essence, you have public money, which is either coming directly from taxpayers or is being borrowed by governments and put in. On the other hand, you've got the private sector who comes in looking for a commercial return, and trying to marry the best of both of those so that, you know, these through public-private partnerships is one thing that ISC does, acts as advisor, which we did on that Solomon Islands project. So I think trying to find what makes sense for the private investors so that they take the proper risks that a private sector should take, and kind of the commercial risk, the risk that their expertise at taking, that they get a return on that is important, but also making sure that, you know, the government takes the risks that it's appropriate for them, the legal and regulatory risks that they control, and that they get what they need for their citizens at a cost to the fiscal budget that's appropriate. So it's making sure that you've got a project that banks will finance, private developers will come into, private equity funds will come into, pension funds will invest, so that the risks are known, you know, kind of quantifiable in the way that project finance is done, and that they feel that there's a sufficient return on the risk they're taking. Quickly, if I may, in terms of smaller projects on the other side, it leads me to my other example, and I'll quickly give you a sense of a project that actually didn't work in the Pacific that we tried for 2.5 years to pull together. And this was a risk-sharing facility that was going to cover small-scale renewable energy projects across 8 different countries. And the idea was to work with a commercial bank to identify those projects. They would finance them and ISC would take the risk. And then we brought in some concessional money to cover a part of our risk so we could get the pricing right. Now, one of the challenges there is you're working across 8 different jurisdictions, legal and regulatory environments. I think we had 5 different currencies. So just trying to structure something like that, and it was a first of its kind in the Pacific Islands. So when you have lots of small markets, the idea is try to aggregate them so you get enough scale that a financier is interested in them. So you can do that by pooling a bunch of small projects and doing them through some type of fund structure, or in this case, we were trying to do it with a commercial bank. But it's really, really difficult. Otherwise, you also need to work directly in a country with an institution, potentially build up their capacity to be able to identify and underwrite these types of small projects, and then ensure they have the financing. But again, I think the financing is not the biggest problem, at least in the Pacific. Money's around. It's really about trying to figure out where these projects are, how to structure them so the private sector is interested.
Thank you, Thomas. I'd like to move on to the next question now, which I think Geoff would be well equipped to talk about. It's with regards to, so one member of our audience has a disruptive agri-tech, agri-tech to site a demonstrator installation unit to prove their concept in the market. Now, they still at development stage and they need to prove their concept, but how can they source the funding or the grant to do as is asked? So I know Camco has
Thanks, Kalsey. And I mean, a fairly short answer to that one, which is depending on the stage of the project and the like, then probably the most, in most markets that we're talking about, the most likely source of that kind of funding is either grant or friends and family at that level of risk. There are some, venture capital style investors who might do it, but I think that's probably the most specific answer I can give, without going into more detail on location and et cetera, et cetera. To come back, if I can, to the bankable projects and the complexity, and I agree with what Thomas was saying about some of the complexity in different jurisdictions and different currencies, and also the complexity of getting a project finance deal closed. And project finance meaning typically a large project which you wrap up and do in a financing package. I think there's a sort of quite often that project finance approach tends to be, people try to apply it to smaller projects, which are quite often what is relevant for islands, right? There are only so many large projects in the islands, and that creates problems because of the complexity and because of the cost, and so. So what's really needed, I think, which Thomas was alluding to, is very flexible capital that can accept the risk of smaller projects in a slightly less standardized or less structured form, and also move much more quickly with lower transaction costs. A slightly trite answer to the bankable, what is bankable question. The definition of bankable project, there is no definition. It's whether a project gets funded or not. And so then it's a question of finding, the right money with the right risk appetite to match against the project's characteristics.
I don't know if Ahmed or Exsley would like to intervene. I know with Ahmed, your new department, with some of the ambitions to have more bankable projects from SIDS. If perhaps you'd like to elaborate on this or present some examples.
Well, I tend to agree with the non-specific or non-straightforward definition of bankable projects, as Geoff mentioned. Actually, it's at the end whether the project receives funding or not, and this is all depending about the risk appetite of the financier. And again, this is depending on the risk appetite and the definition of risk, and how each financier up to its way of doing risk analysis and accepting that. What I would say here is that maybe the most important element is that what need to be looked at very well before defining any project is the overall business environment. I know it's a matter of a holistic approach because we were talking about project finance, but at the end, looking for Ireland specifically, I think what's really very important to be considered is the overall business environment and the business climate. And also, I cannot remember is what mentioned also by Tom or by Geoff, but the presence of local financier to have skin in the game of any project financing is really very important. So I would really encourage very much what I think one of the key elements that need to be looked at, and we are always here in IRENA when we develop any bankable concept note or what we call a project information document, and to see where is the local economy and where the local financing will be available, in order to make sure that they have not only skin in the game, but also to make sure that all of them are crowded in for any financing, specifically when it comes to private sector. I think this is really very important to be considered as well. I think this is my little contribution here, because it is well covered by Tom and Geoff. Thank you.
Yeah, go ahead, Exley.
Thank you very much, Kalsey. If I may respond to those two questions. First, in regards to the Pacific Green Investment Bank. At the moment in the Pacific, our situation is quite different from the Caribbean and African region, where you have regional development banks. In the Pacific, we don't have a regional development bank, and that's discussion that's currently happening at the moment. In addition to that, we do have initiatives such as the Pacific Regional Infrastructure Facility. And also, as I speak, our leaders have developed a new innovative financing facility, which is known as the Pacific Resilience Facility. That is a facility that's intended to invest in small community level projects in the Pacific within the range of 50,000 to 200,000 US dollars threshold. And that is an amount that's usually below the threshold of what the current global climate funds are offering to our countries. At the moment, in terms of our experience with project pipelines, what we would perceive as a project pipeline would be ready-made concepts and proposals, which have already gone through the process of consultation. And I'd like to emphasize that word consultation. That's really important in the context of the Pacific, in terms of ensuring that there's extensive consultation with all the necessary stakeholders to ensure there's buy-in, but also the sustainability aspect of interventions by partners. And in saying that, I think what determines support from the countries as well is the rate of concessionality that different interventions would provide to the region in terms of the interest rates, or most preferably our island countries would want to pursue grant-based financing interventions. And on the issue of ensuring that there is support for offtake guarantees against the risks for investors, what we've experienced in the region is that a lot of the project development would be initiated by the sector agencies. In this instance, we are talking about energy, for example, the ministries and departments of energy. There's also a key role for the central agencies within government, ministries of finance, playing an important role so that they can assist in terms of any co-financing requirements. We've seen projects in different Pacific Island countries fail because sector agencies have been working closely with investors and partners, but they didn't liaise and consult with the central agencies. And when it comes to this kind of commitments, they faced issues with that, and therefore those projects didn't move beyond the planning phases. Thank you.
Thank you. I think you've also addressed another question with regards to some project developers being required to provide a sovereign guarantee, and the government not being able to. Perhaps there has to be more communication, a platform whereby the public and private partnerships can actually, and if the project needs support, like in terms of a sovereign guarantee, there's an equal footing to get this information across. Another question that's popping up is about de-risking. For example, how to de-risk in terms of natural disasters. And I don't know if anybody wants to address the question on how to mitigate the risk when it comes to in terms of disasters.
Maybe I will pick it up this time, Kalsey. I will start from my side with the permission of the all panel members.
Yes. Sure.
Actually, in IRENA, we have developed here together in partnership with UNDP an SE for all, and in close collaboration with Green Climate Fund, or to call it Climate Investments Platform. It's an open platform, but at the same time, it's inclusive, that basically working along 4 main pillars with the main objective of scaling up renewable energy investment globally. The CIP was launched during the UN Secretary General Climate Summit for Climate Change in September 2019. And it works along main 4 pillars. I will start, or the de-risking pillar. The de-risking itself for renewable energy projects is the 4th pillar. But before that, I need to give a very quick brief about the various 3 pillars. The first one is to help countries putting policies and regulations that would attract renewable energy investment. The second one is to set the goals, mainly around the Paris Agreement targets. And the third is to work together with the countries for de-risking the projects. And I will detail that in a second. And the final one is to make smart matchmaking with the interested financier based on the development of bankable project confirmation document that we discussed at length in the previous question. The de-risking here, that we all know that for renewable energy specifically, there are always what we call it the weather risk and environmental risk. In a way, these are 2 key risks that has to be looked at very carefully. And it's not only about natural disaster, even for some type of technologies for renewable energy, like for example, offshore wind, environmental risk and natural disaster risk is always very important to be taking place, not only by looking at any disasters that might happen in a very active way, but it has to be considered in a very proactive way. So these risks has to be addressed properly, even well in advance of anything that might happen. Not only that, but actually with the emerging situation happening globally, and the more funding made available for private sector financing for renewable energy, the issue of providing specific, I would call it risk hedging or risk coverage for such type of natural disaster is becoming very more popular. And actually, if you look at the European Commission, for example, over the past 4 years, they launched what we call it European Investment Plan, that basically availed several billions of dollars to create de-risking guarantees, including all type of risks. Major part of these type of risks and risk coverage is basically to provide natural disaster risk coverage and the other for renewable energy, and it's already provided by several European partners in a very wide range, like l'Agence française de développement, like KfW, like CDC of United Kingdom. There are several here. But the point is that addressing the natural disaster is basically, I think, with the current several financial structured business models, it could happen through risk conveyance, through risk hedging. But what's more important is that could be also covered by private sector insurance facilities. And this is the beauty of it, that at the end of the day, with all such type of risks, there is still new financial product that's emerging, that basically being accepted by wide range of international financial institutions, and also allow private sector to come and invest, even with the, I would say, with the very challenging, or let's say with very specific capacities from governments in islands in order to cope with this disaster, but in the same time still building renewable energy projects. And that's actually one of the issues that we are addressing here in IRENA, and to develop projects that's basically matching the financing criteria, including this risk coverage for natural disaster. And I have to say that is also accepted with the project that we developed for some islands to support this kind of projects. One of them was funded by the Abu Dhabi Fund for Development under the IRENA ADFD facility, and it really works very well. I will stop here looking for the other intervention. Thank you.
Does anyone else want to add on to anything that Ahmed has said?
Yeah,
If
maybe
not,
I could add.
okay.
I mean, so normally natural disaster risk would be an insured risk in a project or in a series of projects. I would say that the insurance market at the moment, it has suffered some losses and it's gummed up a bit, and so it's actually becoming quite difficult in some instances to ensure that risk to the extent that we used to be able to, and I think everyone's hoping that resolves itself. And so at the moment, it's causing a little difficulty, and the premiums have gone up quite substantially. But hopefully in time that'll abate. Who knows with climate change? But fingers crossed.
Okay, thank you. Leading on to that, we have a question from Dr. Karen on how we are defining green energy when financing projects, which I think then ties on quite well to Rakesh's question, where he asks, is it worthwhile for small islands to move towards LNG in their transition towards a greener energy? So perhaps what is the definition of a green energy when financing projects? And then is LNG a good transitional option? I leave the floor open to anyone who'd like to tackle that one.
I mean, let me make myself unpopular and saying certainly to me, green energy is one that does not involve a fossil fuel, and gas is a fossil fuel. I know people would disagree with me, particularly the gas industry. But I think, honestly, that if you look at the cost of solar now and some of the battery technologies and storage technologies that are becoming available at much more competitive and commercial rates, I really wonder whether there's a need for a transition fuel. Hydrogen, I think it's an interesting one. I think it's yet to be demonstrated from a commercial point of view. I saw a study recently that that was sort of, doing the economics of batteries versus hydrogen, and it was coming down firmly on the side of batteries. But I do think there's a lot of interesting work to be done there before we can say one way or the other, which is an optimal outcome. And I suspect that it won't be one or the other. It'll probably be both.
If you allow me, Kalsey, just to come after Geoff. Well, I do agree with you, Geoff. This is exactly the case. 2 days ago, I was in another panel discussion with a lot of Saudi investors, and we had the chief economist of economic intelligence from UK unit, and actually he mentioned something very interesting, matching what you're saying. Out of past year 100 projects in green hydrogen, of hydrogen generation, 95 project was based on green hydrogen and only 5 based on blue hydrogen, which is based on LNG. So I would add my voice to what you're saying. Thank you.
Sorry, Thomas, did you have anything that you wanted to add? I saw you on mute at one point.
No, not really. No, I think for IFC and the World Banks, we're actually moving kind of away from LNG and really looking at the renewable space as real kind of clean green. And it doesn't really help in places like Fiji and some of the islands we don't have access local LNG. Then and you do have sun and wind, and why would you go that direction if there's an alternative that's reasonably priced? Now you get a place like Papua New Guinea, the argument's slightly different there because they have large reserves of LNG, and they have domestic market obligations for the multilaterals multinationals who are coming in and developing those fields. So there's an economic rationale for it, but the other ones I don't really see in the long-term future. I think IFC and the World Bank and most of the MDBs would argue need to be no carbon.
Great, thank you. There's another question from Anton Xavier. In the context of financing green energy technologies, what do you think about striking a balance between centralized high-cost value solutions versus taking a networked, decentralized, lower-cost, high-volume solution approach, which is perhaps better suited for islands? What are your thoughts? So, yeah.
I'll come in for a start on that one. I mean, if you look at sort of large centralized generation, you also need to think about transmission. So yeah, I think that's one of the big challenges in small island states, or even places like Papua New Guinea, where, you know, the topography of the country does not allow for easy transmission. So it almost by definition, you have to have smaller sort of mini grids established. You know, if you can find an economically feasible way, and the economy of scales would probably suggest that you have one giant generation and cheap transmission, fine. But in the small island states in the Pacific, it really doesn't work that way.
Also, I would like to come here to share very, very relevant experience. I agree with you, Thomas. There is a very good example, and actually, if you look at the REN 21 report and what we do in IRENA, this country is Mauritania in the northwest of Africa. The country, if you look at its demographics and its infrastructure transmission system, it has a very unique structure because the demographic and the population is very spread in a very thin, mostly linear line. So the best solution from the banking wise and also to ensure high access penetration rate for the people was basically decentralized solution, non-transmission connected solution, mainly relying on renewable energy with little storage. And actually it worked very well. This has put Mauritania in the top 10 countries globally for relying on renewable energy, solar PV with some battery storage to ensure high access of generation. And I think this solution, again, it's all depending on subject to the infrastructure situation and the demographics of the country. But I think it's a good example to be followed. I know that World Bank and African Development Bank have provided a lot of financing together with Arab Fund for Economic and Social Development based in Kuwait. But this also matches with what Thomas is saying, which I agree. Thank you.
Would anybody else like to add anything? No. Okay, so there's another question on what is the latest thinking on investment ESG models, which take into account the full holistic economic model. Are there any living best practice or living project examples in this area for small island developing states? I leave the question open to anybody who would like to take a shot. Yeah, Geoff, I see your mic is unmuted.
I mean, if no one else wants to, look, I mean, I think ESG reporting and practice is a very interesting, it's developing area, and there are a confusion of standards. At the same time, the big end of town from a funding point of view, so the pension funds and the like, are becoming much more interested in ESG, and there's a wave of money coming looking for a good home. And one of the biggest, sorry, I'm talking around it for a moment, but I'll come to the answer. One of the biggest concerns that they have is that it's proper ESG, it's not just greenwashing. And so, you know, there's a bunch of work being done around standards and practices, but then ultimately, whether that is implemented properly depends largely on both the project and the financier. I think probably without going into a huge amount of detail, if you look at our website, part of our website, impact.camco.energy, and look at impact approach, there's a sort of a summary of some of the standards and issues and measurements that can be used.
Yeah, Ahmed, would you like to, is your mic off to contribute?
Yeah, actually, I don't have a specific example that basically in the states, but I would say that the ESG is a key element for any green investment. And I have to say that it's about, I would say that if you look at for example, let's take the example of IFC and World Bank. They are basically, IFC have very robust, what we call a performance standard. I'm an ex-EBRD, which we call it similar to IFC because IFC is always the origin that we all follow. It's called performance requirement, or PRs. And I think if you look at these performance standards or PRs, regardless of the R or the S, is that basically providing very comprehensive and very thorough framework structure that any project, specifically for renewable energy, that has to come through this kind of passing all these performance standards in order for the project to be eligible for financing. If comparing that with ESG, including the part of the financing and what we call it medium-term expenditure forecast that also has to follow such a kind of ESG structure, I would say it's really very at project finance level is very comprehensive and very robust. And if it would be applied in full-fledged, I think it's really going to provide very good, fruitful results. One of which, let me give you this example. For example, for onshore wind, for the issue of bird migration, I know very well it has to stand for any financing from IFC or World Bank or EBRD or any financing multilateral institution or even bilateral one. It has to stand for 2 years, or at least 2 complete cycle of bird migration, spring and autumn, to make sure that there will be no any kind of impact as ESG governance for a renewable energy project in terms of onshore wind to be considered. So I think it's more about how to enforce more robust action in the ground to apply the full-fledged of this kind of performance standard or performance requirement or any other ESG structure, which I don't see big difference between most of the financing institutions. Even private sector, if I look what basically Blackstone or BlackRock is applying as an example from private sector, it's also very robust. It's all about how do we enforce it in the ground, in the field, in the implementation to ensure its robustness, and how do we ensure more the sustainable enforcement of such a kind of ESG factors. I hope this provides some kind of clarification on my intervention. Thank you.
Our next question is from Sri Lanka. Inuri is asking if what are the viable energy business models that would work for island populations?
I mean, I'm not a technical person on this, but I mean, if you look at sort of I think what Geoff mentioned, kind of solar supported with battery in a small mini grid setting, I think those are the types of plug and play opportunities you may have in small islands. You're in a relatively small space, small villages, where you can actually establish these in a reasonable time from a reasonable cost. And I think the idea of someone else asked the question, how do you link these together? Could you do a series of these across several countries? I think you certainly could. And one way that I see would aggregate something like that is if we had a kind of a holding company where we can provide funding at the top level and let the operating company then use that money to finance the individual projects down in each country, as opposed to doing separate agreements for each small ones, which may be too complicated and too small to carry sort of the weight of a multilateral of IFC. So we would provide you might just give them $50 or $100 million at the top level and let them actually use that money and push it down to where they see best. But that requires us to have a lot of confidence in that developer in terms of their experience or knowledge of the market, so ability to develop a pipeline, to manage a portfolio of assets and so forth. So there are ways, I mean, that you can do it from the financing side.
Maybe just a couple more things to add on to Tom's comments. I think, in those sort of smaller communities, distributed scenarios, there's a few business models that people have been using. Certainly a lot of the stuff we're financing in Africa probably is relatively applicable. So one is a solar home systems business where you're going around with small panels and a few lights and a TV and a fridge connection, that sort of thing. Companies are sort of really following one of two business models there. One is just selling the kit for cash up front, and the other is entering into a sort of a leasing model where they effectively become a bank with a lease book, if I can put it that way. The latter, is obviously reasonably popular, particularly because quite often the end users don't have the cash up front to buy the thing. But what that does mean is that for the company doing that activity, any growth is very utilizes a lot of cash because they are buying all the kit up front. doing the installation, doing everything, and then they might have, say, I don't know, 3 years or something over which they recover that cost. Mini grids are becoming significantly more popular than they were. And so this is where effectively you set up a little local utility. Quite often there's a discussion about tariff and tariff regulation because effectively it's a natural monopoly. But that's starting to become popular, I guess. I'm not sure whether that's the word, but it's the only one I could think of. And probably one of the biggest issues there is deciding what level of tariff is socially acceptable, particularly with the governments. And the governments tend to compare mini grid tariffs versus grid tariffs, and somehow expect the mini grid to meet a grid tariff, which it generally can't, and for very good reason. And so, you know, either you have to have a tariff which is cost reflective, or you have to have someone to subsidize the tariff. And then there's the sort of the local community or commercial industrial captive power model with solar and storage, maybe with some energy efficiency thrown in. So they're kind of three main business models that we've been seeing going around.
Okay, I know about the subsidies and getting IPPs into island to take over from the monopolies can be a bit challenging. So there's a follow-up question with regards to the development of wave action technology. If it's a viable source for SIDS at this point, or is it still too cost prohibitive, and any thoughts on future prospects? Yeah. Anybody?
I can't say I would have the expertise to answer that. I've heard about it. I'm not aware the IRC's financed that as yet, so I really don't know about that one. It'd be great for small island states, though, if you can make it work.
We funded a wave power tech startup when I was in a previous job, and unfortunately the pilot sunk, and so did the company. Look, I mean, I think it's potentially attractive. I think it's commercial in terms of commercialization. It's got a little way to go. Some of it. It's a while since I dealt with it, but then it tended to be relatively high cost. You're high up on the cost experience curve. But obviously, for islands surrounded by ocean, it's an obvious candidate.
Okay, so we've focused a lot about green energy transition, and I just perhaps want to focus on the second part of low carbon infrastructure. So apart from just utility, looking at it from a utility perspective, perhaps what's going on with making more green buildings? What are the government's involvement in helping to promote such like infrastructure for transport, or even the private sector? What's the involvement for that for small islands in like improving public transport or green building codes, policy, etc.? Does anybody want to maybe brush on other low carbon infrastructure projects apart from utilities?
Let me start on that side, on that part, Kalsey. Actually, there is ongoing discussion now at the UN among all international development financial institutions and development institutions like IRENA about what we call it policy-based instruments. That basically, in order for globally to push for more green agenda for development globally, there must be some kind of, and it's a must, it's a need for some kind of policy reform or relevant, let's say, or fit for purpose policy reform in order to ensure first, how can we make more business environment more conducive for private sector investment? There is a very important number here I would like to share with all colleagues and with you and all audience, is that the last measured level of investments in renewable energy globally was up reaching about 800 billion for B from baby of investment. What needed to be achieved every year to meet the targets of Paris Agreement by the end of 2030 would basically at least 2.3 to 2.4 trillion a year. This means there is a need to triple the investment size. And I don't think that the MDBs and IFIs and bilateral financial institution would be able to match that. They cannot make more than maximum in the best case scenario, as per our IRENA flagship report, which we call it World Energy Transition Outlook, not more than 20% of this. So the remaining 80% should come from private sector investments. Not only developers, but also investors or any type of structured finance business model that discussed today or even didn't mention today. So this means that there is a need for opening the markets, specifically in developing economies, in order to attract more private sector investors. If you give an example coming from my region, which I mapped to, which is MENA region, I can tell you that what is a business emerging model now for, because most of the countries in the Middle East and North Africa are basically within the lower or middle income countries. Some very little coming from least developed countries in terms of economic rating. I can tell you that even those countries, you look also for private sector investors, but without providing sovereign guarantee. For some political condition here, the only solutions that used to be or was tested in the past, and I think it has to follow globally, the trend is that what we call it policy-based instrument, including, for example, putting a very robust and very timely intervention for phasing out subsidy globally. I think this is the right moment to be considered, and I know that there is ongoing discussion for developing several energy compacts globally, starting with what will be presented within the coming COP in Glasgow in UK. I mean COP26, in order to see how can policy-based instrument, meaning that there is some kind of linkage for providing any type of lending, whether concessional, very concessional, to be provided with some kind of policy reform that will ensure conducive environment for private sector to come in. Finally, I would like to refer back to the very important intervention that Tom's and Geoff mentioned, and I added my voice at the start of the discussion today, that there is very important need to always to make sure that there is a lot of money there. The problem is not in the availability of resources, of financial resources or lending money. The problem is how to find the bankable project. And a key part of the bankable project is actually how we ensure for the investor when he come and invest that he already all risks that will ensure an acceptable level of financial rate of return coming to him while he's doing his investment. And that's to be happened by mitigating risks up to the risk appetite of the lenders, and also in the same time, how can the relevant executive regulation and policies are in place, in force, well defined, in order to make sure that when investors come in or developer will come in, will ensure that there is a very clear way forward how the project will be implemented and becoming supportive to his investment in return, but in the same time providing all needed socioeconomic and financial impact and energy access to the recipient or hosting countries. I stop here. Thank you.
Hey, Kalsey,
Okay,
could I come in on that one as well?
Yeah.
Just real fast. I know we're getting close to the end, but just to throw out the question around the green buildings and standards. I mean, one thing that your audience may be interested in is what's called EDGE. It's a green building standard that ISC developed specifically for emerging markets. And EDGE stands for, if I'm not mistaken, engineering for greater design efficiency, something like that. But it really is a bespoke system that a number of countries around the world are taking up. And what it does is it focuses on energy use, water use, and then energy and embedded in the materials. So it tries to simplify the approach to sort of green buildings, because a lot of the sort of developed market standards are quite expensive and overly complex for a lot of the emerging markets. So there's a lot of information on ISC's website if people want to know more, but that's something we're trying to roll out actually in the Pacific Islands. Because if you look at how much energy actually is used through constructing and operating buildings, it's really significant. And once you build it, it's there for 20 or 30 years. So if you don't do it right up front, then you're spending a lot of money on energy and wasteful water for the life of that building. So it's good to get that done up front.
Just just to follow up from something that Ahmed mentioned about returns, one question from the audience was, has there been any discussions on the comparison of returns between green and blue economy financing and the typical versus the typical investments in securities and real estate, which are known to have consistent returns? Has there been any analysis on that, or are there any thoughts and views on that? Or is it like a bit of a dicey subject? And it depends on the project, of course. Any thoughts? No.
I mean, I can give you one.
Yeah, sorry, I can come to that as well. Go ahead, Geoff.
Yeah.
I mean, Ahmed might be more aware of sort of, or Tom might be aware of broad research. I haven't seen any myself, but I do think, I mean, certainly what we see is that once solar projects start to get familiarized in a country or a region, they very quickly become hot property for pension funds, because actually they're pretty low risk and typically very reliable, assuming the liquidity of the off-taker can be managed. And so actually I would say that this is a sort of a marketing statement almost, but they tend to be very good on a risk return basis without sort of worrying too much about, you know, competing against. I mean, you know, it's not difficult to compete against the cost of diesel, is it?
Well, if I may come to yeah, if to come after Geoff, while I fully agree with Geoff, let me tell you very good example. You cannot compare apple with pineapple here. It's all depending on market condition of each country. Let me give you an example. Again, sorry to refer to Middle East. An investor could invest with a specific rate for a project. The same investor would invest in Emirates will not invest it in Egypt because market conditions are not the same. The lending by local banks are not the same. The risk rating and the risk profile for country is different from one country to another. And as we've worked on this type of project risk analysis and what is the acceptable rate of return for a project financier or project investor for one country. It's totally different. Simply because of different in market profile in the risk profile from one country to another. You can borrow for renewable energy project in Egypt, but not the same rate you will have it in Emirates. I wouldn't give names, but this is exactly the case. Same investor, but doesn't work from one country to another. So you cannot compare with this. It's what I would say is that there is the market that no one could invest or define the acceptable market rate. The market has to put with its or how should the competition sets the specific market condition and what is acceptable rate of return, and then by rolling in the definition of what is acceptable rate of return is coming. But again, it's up to the risk profile from one country to another. That's why each country has risk rating that different. That's why there is risk rating agencies like Moody's, Fitch, Standard & Poor that basically provide that even at companies level, at countries level. That's basically my intervention here. I don't know how Geoff and Tom's look at this, and Exsley as well. Thank you.
Okay, great. Now we're coming towards the end of the discussion. Thank you very much, the audience and the panelists. And I just want to, before we sum up completely, we still have a few more minutes. I'd like to ask all the panelists to just in 20-30 seconds, if they have any key takeaway points or any advice based on the questions I may have seen that I didn't address that you would want to share with the audience, please. Let's start with you, Exsley.
Thank you again, Kalsey. I would like to end by just reflecting on the question that has come out in relation to building codes. In the Pacific, that is currently a huge challenge that we have in terms of having proper building codes and standards, because in the context of our region, when we talk about that equates to additional costs where it's not affordable to a lot of our Pacific Island governments at the moment. And so I note that there's some work that's currently being ongoing, supported by the brief and also with MDBs, And in particular, Fiji, for example, they've recently reviewed their national building code. And so that will continue to be a challenge for our region going forward. But just generally on the theme that we have been discussing over the last 1.5 hours, I think what's really important to Pacific Seeds is the fact that it's always important to approach interventions in the region with the 4 Ps. We are always familiar with the 3 Ps, the triple Ps, public-private partnerships, but we also need to insert people in the midst of those 3 Ps, because that's really, really important, because a lot of the land tenureship in the Pacific is owned by customary land tenure arrangement. And so the example with the Tina River hydropower project in Solomon Islands, a lot of the delay is also attributed to the land tenure arrangements within Solomon Islands and the host community. Thank you.
Brilliant. Geoff?
I had to have and take myself off mute. No, look, I think the one point I would make is to go back to something I said initially, and then add something onto what Exsley said. So the point I said initially is that a lot of these technologies, clean technologies, are real no-brainers. And let me give an example. So we were dealing with a project a little while ago in Mafia Island, which is just off the coast of Tanzania. And we were comparing it against the cost of diesel, which was what was being used at the time. And the landed cost of diesel was $6 a litre because of the logistics involved in getting it there. And so, it really doesn't take much to compete against that. And most island nations have a lot of sunshine, and a lot of wind, and a lot of ocean energy available to them. And so really it's just a question of figuring out how to use it, and that's going to be good for them in the long term, not just a good thing to do for the climate. The other thing is I think Exsley added people. I'd sort of add people and partnership, so very important to start to use to work with locals, local developers, local people, to the extent that capacity is building is needed to do it, and to try and build up a local ecosystem around this sector within the constraints of a large number of small geographically dispersed countries, to try and get more local involvement into project development.
Thank you. People again, recurring theme. Ahmed? Sorry, you're on mute, Ahmed.
Yes, yeah. Yes. No, well, I would say that I would close that this year, I would call it for us in IRENA here is a year of SEDS. We are gearing up to work with the several partners, starting with the CDC of UK and other big European countries, in order to develop several projects, specifically under Lighthouse initiative led by Germany and Denmark. And we are developing around 10 to 15 project information documents. That's really big, bankable one, meaning that we will, before we providing that with the respective governments within the SEDS, we're basically consulting and fully involving several international financial institutions to ensure that these projects are really matching the risk appetite and matching the financing criteria. I think we need to provide, not I think, I believe that we need to provide more support to the SEDS because they're on the front line of the climate change impact. And I would like, by closing, that we are using our tools like this climate investment platform with the new financing facilities that we are initiating with the Abu Dhabi Fund for Development and other banks to come to provide whatever relevant and needed support in complete ownership with the respective governments. Also involving local banks and private sector is on the priority of these projects that we are going to develop. Thank you.
Thank you. And Tom, last but not least.
I guess I would just make another call to really focus on the role of the private sector in all of this. I mean, I think as a panelist had mentioned, the need is huge. There's a lot of capital looking for projects, but a lot of these markets aren't very attractive for a whole lot of reasons. Legal or regulatory regime, first of its kind type of investments that have a lot of risks in them. So I really think it's important that, governments look to create the environment conducive to attracting private sector investors, and then also the responsibility on bilaterals and multilaterals like the World Bank, IFC, EBRD, African Development Bank, all of them, to play the role that we can play, bridging the public and the private. And I think that's ultimately it's going to have to be really accelerated to meet the needs of the market. But I think it's also just great to see this type of discussion. I'd like to thank the organizers and the audience for joining in. The more we can talk about this, just put them on the table, understand what the constraints are. I think the better off we'll all be in terms of trying to solve some of these really challenging projects that need to be solved sooner than later. The ultimate impact really is on people's lives. So I think that's what we're really trying to get to the heart of. So thank you very much for giving me the chance to join tonight.
Yeah, I completely agree. I'd like to thank the panelists and the audience and Island Innovation for organizing. And I think just in summary, we realize something needs to be done. Innovation is required, and it's not just innovation on the science front, it's innovation to link up public, private sector, people, putting everyone at the heart of to find a solution for this, and just to build a greener, bluer, sustainable, climate safe, resilient future where we don't leave no one or any island behind. So with that note, I'd like to thank everyone, our audience, everybody. Thank you so much. I really hope you enjoyed the session. Thank you.
Okay. Take care. Good night, everyone.
Thank you all so much. Excellent panel.
Thank you.
Wonderful
Thank
day.
you.
Hope to see you at the
Thank
rest of the sessions.
Thank you.
Tomorrow. Bye-bye.